if you're actually being a fiduciary, you don't want all your boxes and allocations to be green. That means you're doing something wrong. But if you're thinking 10, 15, 20 years out, whether you bought gold at 3,300, 2,900, or even 1,800 is going to be immaterial. My target, like Ronnie Sturflis for the next couple of years, is 4,800. But I think it's going, and again, I'm not saying this to just throw it out there. We're going to revalue gold. It's going to be part of the new reset whenever and however that involves. It's certainly replacing the 10-year. We're looking at gold at 10,000 conservatively, not next week, not even next year. Could be, but I have no idea how to predict that.
MatthewPiepenburg, a partner at von Greyerz, believes gold is on a trajectory toward $4,800 within the next few years, and potentially much higher over the long term, with targets of $10,000 or more. His outlook isn't rooted in optimism about the global economy, but rather in the belief that we are moving steadily toward a monetary reset. In such a scenario, he suggests, gold could replace bonds as the primary store of value. A report from GoldBroker titled, "Has Gold Mania Arrived?" reinforces this view, arguing that for gold to be in a genuine bull market in US dollar terms, it must not only rise nominally but also outperform the US dollar index. According to the report, gold has recently broken out of a technical formation that mirrors the gold DXY channel seen from the late 1980s through 2005. The earlier breakout led to a fourfold increase in gold prices over the following 6 years, with the current breakout beginning around $2,500 in late 2024. The same pattern projects a possible move to $10,000 by the end of the decade. But gold's rise isn't about aesthetics or newfound utility, Piepenburg argues. It's about what's breaking down. Fiat currencies and debt markets are under increasing strain. Paper money continues to lose purchasing power. A simple yet powerful truth. From his perspective, gold is rising not because the world is improving, but because the monetary system is faltering. He points to a wave of global de-dollarization to support this view. Saudi Arabia has joined BRICS. India and Russia now trade in rupees. China continues to accumulate gold while slashing its exposure to the US dollar. As analyst Martin Armstrong puts it, the end of a reserve currency is a process, not an event. Piepenburg urges long-term investors not to fixate on whether they're buying gold at $3,100 or $3,600. In his view, what matters is conviction, and a clear understanding that fiat currencies are in decline. Gold, by contrast, has maintained its historical role, preserving wealth when confidence in the financial system begins to unravel. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
For a while, should I buy at these levels? I even have clients I've had for years. Should I buy at these levels? I see dollar cost averaging in, and I just wrote an article that I published today. Is it too late for gold? Have you missed your window? It's an absolutely fair question. And of course, you're going to say, well, Matt's an executive at Zurich. He's going to say, of course, it's not too late. Buy as much gold as you want. And that is my answer. But let me give some reasons why, so I'm not just pitching my book or selling my widget, because it's a fair, and you should be skeptical. But you should also look at the facts and then make your own opinions. First, as you said, gold's at nominal all-time highs this year, but in inflation adjusted, it isn't. We'd still have to go up many percentage points to reach the 1980 levels. And measured against the broad money supply, gold's about as cheap now as it was in the 70s. That's just a fact. You could argue on a technical basis that gold is still a good price in the 3,000, the 3,300, 3,400, 3,500. That seems hard to believe. I remember having this conversation with gold at 2,600. I've missed my window. I remember with 19, because it wasn't that long ago. Gold was at 1,600. And I'm not saying that gold just goes straight up. It could have some severe pullbacks, and you could wait for those. And so the other answer to that question is, and you just answered for yourself, is what's your time horizon? Because if your time horizon is 10, 20 years, as opposed to the next fiscal quarter or year end, and that's why a lot of family offices are afraid, because the CIOs or bankers or ex-bankers, their performance is measured, their salary is measured by their overall return. If gold pulls them down, they're thinking one quarter, one fiscal year. If you're actually being a fiduciary, you don't want all your boxes and allocations to be green. That means you're doing something wrong. But if you're thinking 10, 15, 20 years out, whether you bought gold at 3,300, 2,900, or even 1,800 is going to be immaterial. My target, like Ronnie Sturflis for the next couple of years, is 4,800. But I think it's going, and again, I'm not saying this to just throw it out there. We're going to revalue gold. It's going to be part of the new reset whenever and however that involves. It's certainly replacing the 10-year. We're looking at gold at 10,000 conservatively, not next week, not even next year. Could be, but I have no idea how to predict that. But if I'm looking 10, 20 years out, it's going to be much, much higher than it is today. And whether you bought it 33 and change or 36 and change will be irrelevant in the long run if you're thinking that way. If you're trying to trade commodities or trade futures or trade precious metals, like any hard asset, you better have your stop losses in place. You better be looking at your Bollinger Bands, your Keltner Bands, and all that. If you're purely a speculator, that's a very different question. And I'm not the right person to ask. I've seen many commodity traders fail miserably at trying to time short or long hard assets. Again, but again, if gold does go to 4,800, then to 6,200, then to 10,000, again, that doesn't mean that you're doing the world is doing well. That doesn't mean that you're being richer, but that just means that the cost of a car tire or a house or a new mattress is going to be significantly higher. You can also certainly get price appreciation, but as Egon and I say so many times, it'll be a sad day when gold's at 10,000, but thank God I'm in it. And again, I use Egon as an example. He had made a lot of money as the chairman of a FTSE 100 company. He could have done anything he wanted with it. He could have invested in any asset class. He bought gold at 300, not because he was trying to get rich when gold went to 3,500. This was 20 years ago or 25 years ago. He was just thinking, whatever money I made, whatever money I'm going to earn, it's going to be in a paper asset. It's going to be in a fiat currency, whether it's a Swiss franc or a euro at the time, or at that time, even before, a Deutschmark or whatever. He wasn't thinking, how can I get rich on the money I have and get richer? He was thinking, how do I preserve my wealth? And that sounds very boring. So he just bought gold at 300, a lot of gold at 300. Now, of course, when gold goes from 300 to 3,500, he's extremely happy with the price appreciation. He actually got richer. But more importantly, he didn't get poorer. And that's kind of the model we look at. Yes, he got much richer by investing in gold, but that was never his motive. But you will get richer with gold over the next 20 years, even at these price points, is my short answer. I guess I say think like Egon. And he's been an immense mentor to me because I'm thinking 20 years out. And I'm thinking of my grandkids and my retirement, so to speak, or whatever. I don't really need to be worried about polo ponies when I'm 75 or a new car. I don't really have the desire to get richer, but I could get richer on gold. But more importantly, I know I won't get poorer. And I'm saying that, again, Egon was all about wealth preservation, but yes, he also benefited from massive price appreciation and massive returns. And I think you can get both. And it's a long way of saying if your window is reasonable, respectable, and if you have conviction, because not once did Egon sell his gold when it was ripping into the 80s and then going down in these highs and lows, just stuck to gold because he had the conviction that eventually paper money would do what it always does and go back to its intrinsic value, which is effectively zero. Now, I'll repeat, when measured against a milligram of gold, the US dollar has lost 99.1% of its purchasing power since 1971. We went off the gold standard. That's a simplistic but very important percentage. You can look at it in different ways. But what Egon understood and what our clients understood, and a lot of your viewers understand, it's not that gold is rising over the next 10 years or the last 5 years, because gold has gotten more important in terms of its use or in terms of its shine. It's rising because debt markets and hence currency markets have gotten so pathetically embarrassing and so unsustainable and so discredited that gold is doing what it's been doing for thousands of years, getting the last laugh on failed policies from modern monetary theory and the fantasy you can solve a debt crisis with more debt and monetize that debt with mouse click money. If you're 10, 20 years out, I wouldn't worry, Jesse, whether you buy at 33, 36, or 31. And I'm not telling you what the price is going to be next week because I don't know. No one does. I just know secularly it's going to go north because paper money has consistently gone south, regardless of the relative strengths of currency. I'd much rather have a dollar, a Swiss franc, than a peso. I would. But again, all of us need to protect against the obvious now decline in fiat money. And that's been our message for decades. It's still our message now, but I think Egon's example is telling. It's not a lucky break. It was a thought out conviction that will be just as true for people who buy today for the next 20 years as it was for him 20 years ago. I really believe that.
MatthewPiepenburg points to the gold to silver ratio as a key indicator of where we may be in the current precious metals cycle. In past major bull markets, such as those in 1980 and 2011, the ratio dropped significantly, reaching levels as low as 15 to 1 and 32 to 1, respectively. While today's ratio remains much higher, Piepenburg believes that once gold truly breaks out, silver will begin to outperform sharply, closing that gap. Currently, the gold to silver ratio, which measures the number of ounces of silver required to purchase 1 ounce of gold, remains elevated. It has recently dipped below 90, but the disparity between the two metals remains significant. Historically, a high ratio suggests that silver is undervalued relative to gold, often creating long-term buying opportunities for investors who anticipate a reversion toward the historical average. This elevated ratio also reflects gold's continued dominance as the preferred safe haven asset, particularly during periods of economic uncertainty and geopolitical stress. While silver has lagged in performance, it remains an essential industrial metal with robust demand fundamentals, particularly in sectors such as solar energy and electronics. Analysts at Kitco News note that despite silver's struggles to gain momentum in the short term, many market watchers remain optimistic about its long-term upside. As gold gains further ground, the stage may be set for silver to catch up and potentially surpass it in terms of percentage gains if historical patterns hold. Let's get back to the interview.
Silver's lagging because gold hasn't really begun its bull market rip. I really believe that. I'm not here to predict, there are people on TV or on certain shows calling $600, $700, $800 silver. I don't know, or even $5,000 silver, $4,000 silver. That's a mug's game again. I know at 35, 36, or 37, it's going to be much, much higher than that in the years to come. So it's just a great high class problem to wonder, will it be 50 next year? Will it be 60, 70? But I think the gold silver ratio, we're not seeing the kind of the ratios we saw in 1980 or what was it, 2011 at 15 and 32. We'll see it again. And I don't know when. What I think the silver quote unquote lag, although it's certainly higher than it was 5 years ago. But I'm saying the lag in silver right now is because we haven't really seen the bull market yet in gold. I don't think we have. And yet it's done extremely well this year. It's the highest performing asset. But I think this is just chapter one of the gold story. I really do. But I think for the next 20 years, we're going to look back at $3,000 gold and say, what a bargain. And yet, even if there is a reset or a Bretton Woods 2.0 or a Plaza Accord 2.0, and we somehow magically get cooperation in a beautiful mind, John Nash way with the BRICS and the G20 and everywhere else, even if we get that, whatever new system to come, and even the IMF has said this, despite its central bank digital currency programmability and trackability nightmare, for anything to have credibility in this new reset, they've said it. The BIS has said it. The IMF has said it. The World Bank has said it. For it to have credibility as opposed to just another new electronic fiat, it has to be covered in some significant ratio with a hard asset like gold. And so gold will be, again, playing a part of the new system to come. However smooth, ugly, discredited, or crazy, or whatever pain we have to go to get to that point, that reset is coming. And that new money is coming. And that new money doesn't mean a gold-backed dollar or a gold-backed euro, but it's going to be a gold-covered central bank digital currency. Will it be next year, next week? I don't know. But they're already moving in that direction so rapidly. If you follow the puck, again, it goes from gold no longer just being an allocation or a debate about low inflation, high inflation, low rates, high rates, strong dollar, weak dollar. It's broken from all those correlations. Now gold is simply becoming a strategic reserve asset for the new system. And that's, I think, not spoken of enough. And that is not pie in the sky. That is not sensational. That's actually happening. So, yeah, silver is, I think, lagging only because gold hasn't even begun to rip yet. And I think silver right now at these prices, if you're patient, as Rick Rule said, silver rewards infrequently but extravagantly. Some people say it hasn't done enough for them. If you bought silver at 22, you should be content at 36, but you'll be very happy when it goes into triple digits. And silver is that little speedboat that rips past the juggernaut of gold. It's also more volatile too. So you got to pick your window. What's your exit? What's your entry? I'm going to buy silver so that when it rips, I'll sell it at a certain point. I'll never catch the high top. No one does. And then I'll use that to buy more gold. Hopefully, when gold is lagging silver in the growth space. But that's what most clients do. Silver is to speculate when the situation's right. If you're patient, it will reward you extravagantly. Sell, buy more gold. Is very simply our debt market. It's very simple. The debt is unsustainable, and this gets into currencies and gold. But look, global GDP went from 30 trillion in the 90s to 300 trillion today, just globally. And in 1971, when we got off the gold standard, again, these are boring numbers, but U.S. debt, public debt, government debt was 246 billion in 1971. Now we're looking at 37 trillion. That's extraordinary in a 50-year period. And our debt to GDP in the 70s was 38%. Now it's at World War II levels of 125%. And again, I'll pause for a second. Just trying to think of those as just me showing up with numbers I can memorize. Think about what that means when you go from 240 billion to 37 trillion. And Rubino had told me something else was very true. You know, a billion seconds ago was 1997. A trillion seconds ago was 30,000 BC. Just to try and conceptualize the difference between a trillion and a billion. So when you go from 240 some billion in public debt to 37 trillion in a 50-year period, it becomes inconceivable. Not only is it inconceivable, it is mathematically unsustainable. So when I'm to answer your question, the debt market and the rise of the cracks in this broken system is going to be, in my opinion, what breaks the stock market. And we are clearly seeing that now. You know, Egon, my colleague, said in 2016 that U.S. public debt would be 40 trillion by 2025. And he looked like a total kook. They thought he was crazy. But that's exactly where we are because our debt doubles every 8 years. So the bond market is the thing. And a credit collapse on sovereign bonds like the U.S. 10-year, the risk-free return, which again is return-free risk when you measure against actual inflation. When the debt keeps getting bigger and bigger, our deficits go from every 6 months up $1 trillion. Our public debt gets higher and higher. Our entitlements, our military spending, our interest expenses. It comes to a point where that pressure cooker pops. We've seen signs of that in the de-dollarization and the rise of the BRICS and the COMEX outflows, in the BIS giving gold a tier 1 status alongside the 10-year. We've seen that in the petrodollar moves outside of the US dollar, blah, 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 blah. But that's all happening because no one trusts the world reserve currency today like they did 10 years ago. And no one trusts the 10-year IOU from Uncle Sam like they did 10 years ago. Why? Because we're in too much debt, because no one thinks it's sustainable, and because we weaponized that world reserve currency in 2022. Again, whatever you think of that, it's no longer trusted. What central banks have been doing since we weaponized the dollars is mathematical. They've tripled their gold buying. Every year since then, central banks have bought over 1,000 tons a year. Individual central banks went up from 118 tons to an average of 290 tons. They basically tripled. Why? They don't trust the world reserve currency as a weaponized currency. They don't trust the 10-year IOU because it's weaponized, and they don't like it because they know the government cannot sustain the debt. So there's a move away from that IOU. If there is a move away from our debt and we are a debt-based society, who's going to pay that debt? If they're not going to buy our IOUs. Net, central banks have been net dumping IOUs since 2014. China's been de-dollarizing since 2013. These are not just numbers. These are signs of trends. And the trends are getting more and more accelerated. As Hemingway said, poverty starts slowly, then all at once. We are hitting that all at once phase objectively. There is simply too much debt. There is a move away from U.S. treasuries into physical gold to net settle trades in the BRICS, to buy oil, to settle energy trades, and even as a world reserve asset. So we're not even talking about gold anymore as a hedge or an allocation or even insurance for dying fiat money. What we are seeing in the last couple of years is gold is replacing the U.S. dollar. Nassim Taleb just said this out loud the other day in an interview with Bloomberg, constructively replacing the U.S. dollar as a strategic reserve, or the 10-year U.S. Treasury, and the dollar as a strategic reserve asset, as real money. The kooky conversations that gold bugs have been having for years about credit or currency versus money or credit versus real money, that was all laughed at, is actually happening in real time.
Confidence in conventional financial systems appears to be eroding faster than many anticipated. With sovereign debts piling up, fiat currencies under sustained pressure, and global alliances shifting their monetary allegiances, gold seems to be reclaiming its historical role, not by innovation, but by necessity. At the same time, the yawning gap between gold and silver valuations hints at a possible catch-up rally that could reshape the dynamics of precious metals investing. The signals aren't just technical. They're structural, geopolitical, and increasingly urgent. Could this be the inflection point where gold asserts its dominance and silver stages its long-overdue breakout into financial relevance? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.